Hello and welcome to episode 249 of the Money to the Masses podcast with your resident expert as always, Damien Fay and me, Andy Leakes. Damien, how you doing?
I'm good. It's been a busy week, Andy, and we're one show away from that magical 250th episode.
What a Christmas treat, eh?
It is a Christmas treat. And don't forget, if you want to be on that episode, then do send in your voice messages. We've done a video. We created a video on our Facebook and Instagram. You can go and find the video of us explaining how simple it is to send a voice message in for that show. And don't forget, if you send one in, you're guaranteed to get a Money to the Masses mug. If you get on the show, you are guaranteed to get a limited edition I've Been on the Money to the Masses podcast mug. So do send that. And a big shout out to all our female listeners. Now, I know there's a lot of you. I've met many of you and get emails, but please do send in your voice messages because we've obviously got a bit of a skew towards the men. The men are keen to get their voices heard, and they will do, but we want more women as well. So we see a lot of you on social media and leave us messages and communicate and engage, but send us in your voice messages, please.
So as Damien said, yeah, it's super easy. Check out that post. I mean, in really short terms, you go into Facebook Messenger, type in Money to the Masses. There's a microphone icon there. Record your message and it comes to us. It is really that simple. So what have we got coming up on this week's show?
Right, we've got 3 pieces as usual. One of them on an investment theme, and it's to do with fund suspension. So a bit like Woodford, but we're talking about property funds. And there's been some news that's broken this week, which is no surprise really. But if you've been listening to these podcasts over the years, it shouldn't be too much of a surprise, but of a major fund suspension and a fund that invests in property. Now I want to talk about that, the how, why, what it means, what the outlook is, but also pull it all the way back towards Woodford and what you can do about it, because there's some interesting developments on that front as well. The second piece I want to talk about is a product that is probably the most eagerly awaited financial product I've known for many a year, the Vanguard SIP. Now, I don't normally do product-specific stuff, but in this instance, the Vanguard SIP would become the cheapest pension in the entire UK, and it will be incredibly attractive to people, but obviously there are pros and cons. So I was invited into Vanguard headquarters to go and have a look at this product because it's not actually available yet. It's not going to be available to early 2020, but you would have seen a lot of noise about it in the press, but they got me in to have a look at it and have a test run of the product. So no one else would have done that as far as I'm aware, so you would have heard something here first about the Vanguard SIP. And finally, the last piece of the podcast, I want to talk about selling your house to your children. And this was inspired by a piece I read in a paper about somebody who wanted to sell their buy-to-let to their children, and they wanted to do it at a discount price. And I want to talk about why that is could be a bad idea.
Brilliant. So we're going to start with the main investment piece.
The main investment piece. Now, the news broke this week that the M&G property portfolio, which is a fund, is a unit trust. So it's what they call an open-ended fund. And that is of a size of 2.5 billion. So it's a big old fund. It's got a lot of money in it. And the news broke that they've closed it. So they've shuttered it down. So not closed it in the terms of it's not in existence anymore. They're not allowing you to withdraw money from it. So in a similar fashion to what happened with Neil Woodford and his unit trust. So they've shuttered it. The aim is that the fund will open up again, and they always have it on a 28-day cycle where they go through and review things, whether they can open it. But it's an important story because it highlights a couple of issues within the sort of investment market and the wider backdrop. So why has this fund closed? Now, if you go back to 2016 and the aftermath of the Brexit referendum, a number of property funds, so we're talking about the open-ended funds, the unit trusts, they were closed so people couldn't withdraw their money. And the reason that occurred is the way a unit trust works is that if somebody wants to withdraw their money from a fund, so if an investor wants their money out of the M&G property portfolio in this instance, then what happens is the manager will try and give them their money back. So they'll normally have to sell down some of the assets that are in the fund if there's not enough cash within the fund, so a liquid portion, so some money. Normally funds have about 5% cash to meet the withdrawals. If you get a run on a fund and the assets are illiquid, now you've got to think these funds that I'm talking about are property funds that invest in bricks and mortar. So they invest in the office blocks, the shopping centres that you shop in. You may not realise it, but when you go around your town or your city, you may see, for example, a warehouse or an industrial estate. And some of these funds will own large portions of these entities. So like I say, shopping centres, because they're good investments. They can provide rent from the companies that are within them. So these funds will obviously own these large corporate commercial properties. But if you imagine if a fund of 2.5 billion suddenly had a load of people want to have their money out, then they would have to try and liquidate some of their holdings, and you can't sell part of a property. So what it would mean is they're going to have to do a bit of a fire sale and sell an office block, and that is obviously very difficult given the size of them and the scale of the and the price of them.
And I imagine the time that would take as well. It's a nightmare. I mean, I'm trying to move house at the moment. It's been going on 4 months. So.
Exactly, Andy. And the other thing you have to bear in mind is they're trying to protect the investors that are still within the fund. So if you do a fire sale and you sell everything, then you just start selling it to the first person who comes along. It ends up being ridiculously cheap because people know you're being a forced seller. So it's like you said, Andy, if you were selling a house and you had to move for a certain reason, or you were desperate to move, that's why somebody can use that against you and offer you a lower price. So the M&G Property Fund had to shut its doors because the number of people who wanted their money out was accelerating and they couldn't meet the redemption requests. And the reason this occurred originally back in 2016 was because of Brexit. So everybody feared that what would happen in the UK, the UK economy, the UK property market, and of course international investors were starting to pull their money out. And what it meant was that the funds basically most of the property funds, we're talking about unit trusts, not investment trusts, we're talking about unit trusts. Investment trusts, their structure is different because they're closed funds. What happens is you buy and sell shares in that investment trust, so the manager doesn't have to sell anything or do anything if people don't want to have their investment anymore. It's just like you're selling shares in a company. So you sell shares of the investment trust to another person who wants shares in a property investment trust. With a unit trust, what happened in 2016, they had to gate the funds. Now, most of them reopened again after about 6 months, but it meant that investors were trapped within those funds, or some of them had it where if you got your money out, there was a massive discount that was being applied to try and discourage people. And the reason this works is because it's trying to protect the people still within the fund. Now, we had this happen this week, and one of the reasons the M&G property portfolio got impacted first is the fact that, yes, it's obviously a property fund, but it's exposed largely to retail. So you're looking, if you go down the high street and you look at the empty shops that you see, or you see some of these out of town retail outlets that start looking more and more empty, that starts to impact the people who own the buildings. Because don't forget, the shops don't necessarily own the premises, it's a landlord, and that can be one of these funds. So they were already having issues with the return on their investments anyway. And of course, we are now at a UK general election where we've got a Brexit deal potentially on the table. This has become very much more about whether Brexit is going to happen now, looking more and more likely. So over the last 3 years, we've seen periods where the rate of money being withdrawn from property funds has accelerated or decelerated, and it was largely dependent on what people thought was going to happen around Brexit. And so now we're in a scenario, UK election this week, and possibly a Brexit a couple of months later. That might happen, it might not. Then investors have become nervous and they pulled their money out. So M&G are the first fund to do this. Now, I put out a tweet this week that said, look out, this is going to be the first of many. And I do believe that. This is just a personal view, but if history is a good enough guide, then other funds will be having to follow suit. Now, the M&G property...
And is that a self-perpetuating thing? People look at that and start looking at their own situation in their own fund, and then that creates the problem, or is it just a market thing?
People could sit there and go, Damien, you're talking about this on the podcast, and people listen to you, and if you're saying to them, like, beware, the other property funds are going to start closing. I mean, I have been saying this all along since 2016 when it first happened, and I wasn't in property funds then. Between 2016 And to date, I have held property funds in my 80/20 portfolio because the risks drop. But then for about the last 18 months, I've not held any property funds. When I say property funds, those that invest in bricks and mortar, because of this rise in risk, and it was always a potential. And while the M&G, I have to point out that M&G property portfolio is waiving 30% of its annual charges while it's been locked.
They learned from the Woodford debacle then.
They've learned something from the Woodford debacle, like you say. But the other reason I get access to various numbers, and I pay for a lot of data that I use to run and crunch numbers for 80/20 investors, and it produces research pieces for the members. Now, I sat there ahead of this podcast and crunched the numbers, which looked at the movements of the various different property funds, the UK direct property sector, and took into account market moves, and then looked at the size of the fund 6 months ago versus today. Now, if you do that, you can then work out how much money is leaving the fund, because if the fund has plummeted in value, yet that can't be explained by the fall in the value of the actual underlying assets, then you know people have been withdrawing money. And I don't want to set alarm bells ringing, but I will do. But this is just
these are the red flags.
These are the red flags. So the M&G property portfolio has lost £514 million in the last 6 months. That's how much it's been withdrawn. That's not lost in terms of performance. I'm talking about people have pulled from it. Bearing in mind, I told you earlier that it was worth 2.5 billion at the moment. Mm-hmm. You can see that's a big number. That's why if a fifth of the money, or up to a fifth, was being pulled out over 6 months, and they didn't have enough money in cash, then you're going to be some red flags going on, that they couldn't meet the withdrawals. Now, other funds, so there's a Henderson have a UK property fund that's had 327 million taken out. Threadneedle have a UK property authorised investment that's £279 million has been taken out. Standard Life UK Real Estate is £184 million that's been taken out. Pretty much you can go through anyone in that sector, and the numbers are of this level. There are one or two that aren't, but what it's just showing you, this is a asset-wide issue. So don't be surprised if you see other funds that do start to gate for a temporary period until we see what happens with Brexit. Now, this raises the question of illiquid assets and unit trust structures. They're not really suitable, and this came to light after the Woodford scenario. Now, one thing to bear in mind is all about whether these funds have the cash in the fund to meet redemptions. And one of the big things about the M&G fund is, according to some analysis by AJ Bell that was reported in This Is Money, that the M&G fund only had 5% of its assets available in cash, whereas some of the other funds, the Threadneedle fund had 10% and the Janus fund had 16.7% back in October. It mentions about the Standard Life funds have similar amounts held in cash. I'm just looking at it here. So you can see some already preparing. They know this kind of issue is coming. So it doesn't mean every fund will necessarily gate, but if this starts becoming something that becomes self-fulfilling, don't be surprised if they don't. In 2016, not every fund did gate, but a lot of them did. So going back, this is a kind of a scenario that we've seen with Woodford. And one thing to make clear, it's not the same as what happened with Neil Woodford. Yes, there's this illiquid asset held in a unit trust structure, which is not really appropriate. Because with Woodford, he held illiquid shares. He held shares in very small companies. And that was the issue. And also, there were concerns about whether investors actually knew what was going on. Now, that's why Neil Woodford collapsed. With these funds, it's because the redemptions and the liquid assets don't really tie up. And they will probably open up again at some point in the future with this particular M&G property portfolio, as they had done in 2016. Now, what was interesting, I was looking at some numbers, this story about Neil Woodford, and looking at it with a bit of hindsight. And if you remember when I talked about it, Kent County Council, which obviously I can see Andy out the corner of my eye shaking his head, had £260 million in the fund. And this was the Woodford fund that eventually collapsed. And they, at the moment, still have £197 million still in there as of September. So you can see the amount of money their holdings have lost. So that's over £60 million they've lost in the interim since the fund, everything went basically wrong. But the reason I want to bring this piece up is for people to be aware generally about this whole issue in the fund management industry. But there were some other bits and pieces I've been looking at recently about the rise of in-specie transfers for people who were stuck in the Woodford fund. And this was something that's quite interesting that's happened where financial advisors have been advising clients to move the stuck Woodford funds. So the Woodford funds they can't trade in. They are now allowed to move them in specie, which means you move them from one platform to another, but it doesn't involve like a buy and a sell. They're actually allowed to move them across. It's not classed as a trade, as that's not allowed in a suspended fund. But what these advisors have been doing is allowing people to move let's say they've got the Woodford fund in their pension, to move it across to say a SIP or a SAS, so that's a small self-administered pension scheme. And under those rules, they have been able to borrow money against the value of the pension, so it's against the net asset value, and in doing so release money equivalent to the value of that locked up fund. So it's a slightly convoluted way of trying to release cash for somebody to start investing again rather than it being stuck in the Woodford fund. Now, there's lots of questions about whether the advice is suitable, etc., etc. And if you even contemplate something like this, then you need to be seeking financial advice because it has to be about whether it's suitable. But I mention it because it was an interesting aside that there is a rise of people who are trying to find ways of releasing value from a fund that is suspended, and that is by doing one of these in-specie transfers. Of course, the issue also comes down to cost, because in-specie transfers can be expensive. They're more so than just normal cash transfers, and of course, the time it takes as well to do so. And you could end up having two pension schemes, because you could end up having an old pension, you could have a partial transfer if your existing scheme allows it and you're paying double the cost. There's also the question whether your existing scheme would allow a partial transfer out of a pension. Not all of them do. And also if there's a case where people decide they just want to move away from somewhere and leave that Woodford fund behind, so rather than doing an in-specie transfer, almost just leave it behind and go elsewhere with the rest of their fund. And I know there's quite a few people who have been disgruntled with their particular platform. It's the question whether that particular pension provider will be happy with you just leaving a suspended fund in their pension. And also, not everyone can do it. If you've crystallised a pension, then you won't be able to move money across into it. So there's lots of caveats, but it was quite an interesting anecdote aside that there are people out there who are advising clients of ways to try and release value from a suspended fund. But the big FYI is, keep an eye out. If you've got direct property funds, so those invest in bricks and mortar, then you may want to be looking at it and trying to reduce your exposure to it, because there's a very good chance that you could end up locked in it for a period of time.
Okay, we're going to be talking about a long-awaited product, and we don't really normally talk about products specifically, but this is something, there's been a lot of noise and it's been a long time coming.
Yeah, so if you go into our Facebook group, which you all should be in our Facebook group, you will know that Vanguard is highly thought of, and I mean I think very highly of Vanguard and its various products. I mean, everything has its pros and cons, that's the thing you have to bear in mind. But the Vanguard started in America and it came to the UK. It's a massive asset manager. I mean, it's I don't know if it is the world's biggest yet, but it was certainly up there. I'll have to look at the numbers. The rate they're acquiring assets is quite incredible. And they basically run a whole bunch of ETFs and funds. Most of them are pure trackers. So they end up tracking an index, or they may end up tracking a certain asset or whatever it is. So there are also active funds. I've had some active funds on their range, and they also have these funds called life strategy funds, which are basically like a mixed portfolio based upon the equity percentage that you want to have. So they might have a 60% equity percentage. And I've written lengthy reviews about Vanguard. Now, historically in the UK, they only sold their funds predominantly via financial advisors rather than direct to consumers. That was their main channel of getting their funds out there. So that's why they're not really a household name as such. Then you could also buy them direct through platforms if you wanted to as a consumer. So you could go to the likes of Hargreaves, whoever that it was, and you could buy Vanguard funds as well. So that was another popular route. But then what happened 2 years ago, Vanguard decided to launch their own platform called Vanguard Investor. If you want to know more about it, then do go look at our review online. Now, Vanguard Investor is a platform that only offers their funds, Vanguard's funds. At the moment, which is still the case, you can get a general investing account, you can get a junior ISA, you can get a stocks and shares ISA through it. and it is ridiculously cheap. So their typical fund charges are 0.06% up to about 0.8% a year. That is standard wherever you buy them. So if you bought them with Vanguard Investor, their platform, the price is the same if you bought it with Interactive Investor. Where it differs is the other charges that they apply. So they have a annual charge on their account, so which is the equivalent to the platform charges elsewhere of 0.15% with a maximum charge of £375 a year. So that is cheap. Now, what's been interesting is that people have been wanting to invest via a SIP, like a pension, and they never launched one when they came to the UK. Now, that was because launching a pension is not the easiest product to launch, and they took far longer than they planned, and we finally got it. So everybody was going nuts this week. Even our Facebook group, somebody woke up early and put the press release in the group to say about it, and almost immediately I'd got an email from Vanguard inviting me to go to their head office to go and look at the product one-on-one, see the development product. Because the thing is, with all the excitement about the Vanguard SIP, you got to remember it's not actually been launched yet. They've now confirmed it's going to be launched in early 2020, and people who want to go in drawdown using it will be able to use it in the next tax year. But of course, all the newspapers have gone ballistic over it. And it's quite understandable, because when you think of it, because when you look at it at face value, apart from the charges that I've just described to you, there are no other charges. Now that is quite amazing. No drawdown charges, no exit charges. That makes it incredibly cheap. Now I just want to, before I go on and talk about the product itself, because there are some cons to it. Not everything's positive with every product you see out there. And the pros of it obviously are the cost of it. Their funds have got a decent range. It's only their own funds. That's one of the drawbacks. But they are passive, and cost is one of the biggest things you need to control in the long term. So that's big ticks all around. You can technically invest in Vanguard funds more cheaply elsewhere. If you go to iWeb or Interactive Investor, if your portfolio is above a certain size, in the case of a stocks and shares ISA or a general investment account, if you have more than £80,000 in Vanguard funds, it's actually cheaper to hold it on, for example, Interactive Investor. And that's because they charge a fixed fee, not a percentage like Vanguard does. The percentage fee is eventually capped, but that cap is higher than the fixed fee that you get at Interactive Investor. So if you've got less than 80 grand in Vanguard funds, then Vanguard Investor's platform is cheapest for you. More than that, then Interactive Investor becomes cheaper, or iWeb, for example. And the benefit is you can hold funds elsewhere as well. You can hold any fund you want. So you can mix and match. Most people do. They don't all just hold Vanguard funds. Now, the interesting thing with the SIP is that because Vanguard don't charge an admin fee on their SIP. Now, every other provider out there will charge an admin fee for a SIP. It's a product specific charge. It's normally about £120 a year. Because Vanguard will not charge an admin fee when they launch their SIP, which is quite amazing. What it means is that you need to have £160,000 or more in Vanguard funds to make it cheaper to be on another platform like Interactive Investor. So it's a great product on charges. So that is one of the big things that people will obviously like. Now, I was offered to go and have a look at the product, and because it's not coming out till next year and no one else has really gone in and seen it, the press have written press releases about it, or written about the press releases, I should say. I wanted to go in there and look at it because obviously we write a lot about Vanguard, and Vanguard are aware of that. So I went in there, sat in a room with some people showing me, driving through the platform, how it works. To give you an overview, it looks very much like the existing platform, just with another option of a SIP. They made it very streamlined, so there is no bells and whistles as you'd expect. There is very simplistic menus, which is a positive. You can open up a SIP. They did it in front of me. I saw how they did it very quickly. So if you already are a Vanguard Investor customer, you'll be pretty happy. Even if you're not, it doesn't matter. Self-employed people are going to be pretty happy, I think, because you can pay from your company into it, and also you can have third parties pay into your pension for you. For example, a spouse may pay in for their partner to try and build a pension pot within the obvious rules. They will accept transfers, which obviously a lot of people will be happy about, but there will only be cash-only transfers. There's no in-specie transfers. That makes sense, though, because in-specie transfers are where you move from one fund to the exact same one on another platform, and that won't necessarily be available. But as an aside, I recently did a pension transfer for my dad and did some of that, or attempted to do it in specie, and it's an absolute nightmare. And go and look at the conversation that we've had, or the thread that was in the Money to the Masses Facebook group, and almost unanimously people are saying, do you know what, when I just did it as cash, so you are out of the market, so what you do is you sell the funds within your pension or your SIP, and the cash moves over. It happens within weeks, like 2 weeks, and then they can buy the funds they want, rather than try and maintain your position in the market so the market can't move against you. That tends to be when problems occur, and some people in there had in-specie transfers going on for 6 months, and it shouldn't be like that. The FCA needs to act to make sure the in-specie transfers happen as they are supposed to, but they do drag on. Anyway, I digressed. The one thing I do want to throw out there that people need to be aware of, the drawdown thing is very attractive because there's no charges for going to drawdown. Other providers start to apply drawdown charges when you start to want to take money from your pension. Now, people might not realise, but you could, in theory, have a SIP that you're building and growing. When you get to retirement and you want to retire, you could transfer that to someone else before you start to go into drawdown. And the cheapest SIP pre-retirement is not necessarily the cheapest SIP post-retirement. So we've done a whole article on this on the website that looks at these charges, which would be you might want to have a look at if this interests you. But of course, obviously Vanguard is very attractive. Now, I just want to throw something out there. As it stands, and it's not even a launch product yet, but it's about to be launched in the early 2020, they have deliberately not allowed people to go into drawdown before the 2020-21 tax year, so the next tax year, because they need to be able to be ready to be able to operate properly. And one of the issues you're going to have going forward, I see for Vanguard, and they were quite open about it and they're going to try and build solutions, is that if I want to build a portfolio that is a sustainable, going to produce an income going forward, we've done a podcast show on this. If you want to build a growing, sustainable income over time, one of the best ways to do that is with equity income funds. So you draw the natural income that they produce. As it stands, Vanguard doesn't really have many income solutions. They do have a couple of equity income funds, but where active management does seem to come into its own is the ability for managers to pick and choose reliable dividend payers. So an equity income fund will have dozens, even 100 companies within it, and takes the dividends that they pay out, and then that fund manager uses those to pay out to the investors. Now, hopefully in time, Vanguard will have some better solutions down that road, and they assured me that they would do, because for me, that's the one drawback. It may be cheap, but in drawdown, when you're going into retirement, the level of options that you have if you want to go down that road are limited. It seems to be very much geared towards you cashing in lumps of your pension. It can be done regularly, you can set it up, I've seen the functionality, but chunks from your pension at the moment, so you'd be taking from the capital. And as I said, they are developing the product. It's very early stages, of course. That is something I'd love to see them change, and we'll see where that goes, because obviously overall you don't want to try and keep taking chunks of your pension if you want it to last you for as long as you can. So there you go, that's the Vanguard SIP. I've written about it online, you can find out more if you want to, but keep watching this space, because in the new year when they do launch it, I will publish a full warts and all review.
Excellent. So moving on to the final piece then, we're going to be doing a bit on property.
Yeah, this was inspired by an article I actually saw. It was in the Guardian, I think. Somebody asked a question about, they wanted to sell their buy-to-let house that had people in it paying rent to their kids at a discount. And could they do that? Because they wanted to sell it at the price that they'd bought it for, not trying to profiteer from their kids. And I just want to give you a quick whistle-stop tour of the issues with that, actually, because there are some issues. I mean, the big thing is, I know there are people out there who do buy-to-let. I speak to you at our meetups, and it's quite a popular thing still to be doing, despite the various tax changes that have occurred over the last few years. But in short, you can do what you like when you have a property. There's nothing to stop you selling a house to somebody at a discount. There is nothing. The problem is that the taxman's not stupid. The taxman will get his or her money no matter what you do. So you can sell a house to your children if they're over 18. That is fine. And so they could buy that house jointly. Whether you want to do that is another question, because will they all fall out? That's something that is only person trying to sell it to their kids could ever answer if it's a good idea. But if you sell your buy-to-let to your children, even at a discount, the taxman knows it's gone at a discount. The way CGT, capital gains tax, works is it looks at market value. So it looks at how much the property should have been sold for, and then works out your supposed gain from that, even if you'd sold the house at the price that you paid for it originally. And then the amount of tax that you pay will be calculated accordingly. So sell it to your kids at a discount, but you could still be, or will still be, potentially hit with a capital gains tax liability. Now, the other issue is if you sell your house at a discount, you're basically gifting your children an amount of money that's the equivalent of what the price you sold it to them at and the value. Now, that's got inheritance tax implications potentially, especially if you die within 7 years, because if you remember, there's a 7-year rule. If you gift something to somebody and you don't survive 7 years, then there's a potential tax liability there. The other thing is, from the children's perspective, if they are first-time buyers and they are not planning on living in the property, then they wouldn't benefit from the first-time buyer's stamp duty relief, because if you remember from a past podcast, then up to £300,000 there is no stamp duty to pay for first time buyers. I mean, like I say, there are rules around all of this, but that wouldn't be applicable to them. And of course, the other issue you've got, if they already own a property themselves, then they could potentially have to pay additional stamp duty. Do you remember if you own a second property, you buy another property, there's that extra 3% tax rate that's applied on top of the standard stamp duty rates. And of course, if they're not living in it because there are people renting this property, then there is the potential of, well, they won't get any primary residency relief. So now if I sell my house, I live in it, it's my primary residence, I don't pay capital gains tax on it. There's none of that relief on there. So the message is, it's a very good example of something that people would think about and go, do you know what, I might sell this to the kids so it's a good income for them. And while that seems a very simple thing to do, there are quite a lot of tax consequences or potential tax consequences there. I mean, I've mentioned capital gains tax, inheritance tax, stamp duty, additional stamp duty. So the message is there's a lot to think about.
So as Damien said at the start of the podcast, it's our big 250 next week, 250th episode, and we're asking you, the listeners, to get in touch and send us your messages. And this is a bit of a battle cry for the female listeners of our podcast. Please do get in touch, because we know you're out there, you're asking lots and lots of questions, and yet we've had very few messages in from you, so please do get in touch. There's details of how to do that on our Facebook community page, but essentially get onto Facebook Messenger, type in Money to the Masses, and it's fairly straightforward from there. If you want to get in touch with Damien in the meantime, of course you can do so. It's Damien at moneytothemasses.com. Instagram, it's at moneytothemasses with the number 2.
Oh, and one thing I just want to mention is don't forget to look at the Facebook and Instagram and everything over the Christmas period, because we are doing a Christmas tree, an advent calendar, where everybody who's ever won a mug, a Money to the Masses mug, has the potential to appear behind one of the stars that we turn over every day. So every day so far in December, we've turned over a numbered star to reveal one of you out there as our person of the day as such. So if you've got a mug and you've not sent in a mug shot yet, then please do so. You've got plenty of time, because we can update the people behind the stars. It's not set in stone who is behind each forthcoming star. So make sure you send in your mug shots.
Yes, get your mug shot to appear on a mug tree.
Yeah, there we go. So until next weekend.
Until next time.